we're in kind of a long grind towards higher inflation, less globalization, more energy shortages, and structural deficits. So the long-term debt cycle was, in that phrasing, was proposed by Ray Dalio. Years ago, what I did was I kind of took his observation and I reconstructed all the numbers myself. And I went through kind of all these data sets and looked at it from multiple angles. And I analyzed the problem. Everybody knows like the short-term credit cycle. So the 3 to 10 year normal business cycle, during an expansion, you generally have more debt to GDP, say more corporate debt, more household debt. Then you have some sort of shock, contraction, central bank tightening, whatever it is that they kind of pop some of that bubble. And then you get a deleveraging event. But then it causes a recession. And so normally then you get policymakers come in, central banks cut rates, fiscal policy generally gives some sort of stimulus, and that kind of short circuit the deleveraging cycle. And so you don't deleverage all of that debt to GDP you build up during that prior cycle. You might deleverage half of it or a third of it, and then you start building up from there. And so instead of looking like a sine wave of debt to GDP, it's like an upward sine wave. You get higher and higher debt relative to GDP, and you get lower and lower interest rates. And that's what enables more and more debt accumulation. And that works until you run into roughly the zero bound. You get zero interest rates. Even in some cases now, it's been a news story of these mildly negative interest rates that we've seen. The question is how, if debt is super high and interest rates run into zero, what do you do during the next crisis? And so that's where you get to what's the long-term debt cycle, which is usually you have a gigantic banking crisis and private deleveraging. And so we saw that in the United States in 1929 going into the 30s. And then we saw that in 2008 going into the 2010s. And so those periods match up very similarly in terms of rates running into zero and private debt to GDP reaching record levels. And then what happens generally is you start to get a rotation. Instead of relying on monetary policy, because that's, the tools are pretty much used up at that point, and you start relying on fiscal policy. You start doing more handouts. You start doing more, stimulus checks. You start doing more wartime spending type of dynamics, right? So the 2010s are really about that kind of gradual grinding, deleveraging, and then putting debt, from the private sector onto the public sector. And that's generally a pretty disinflationary type of environment because when you have that private debt deleveraging, people don't have a lot of extra money. It's just kind of a slower growth or a negative growth environment depending on how bad it is. Then the question is, what happens after like a decade, right? So that whole period, the problem there, both in say the 1930s and the 2010s, is the pie is no longer growing in the way that it was. There's not this cheap credit everywhere in the same way. There's not higher and higher debt to GDP. So there's more rising populism. There's more kind of discontent with how the system's structured, with the prior institutions, more polarization, political polarization, both domestically and then unfortunately between countries as well. So basically the rising populism in the 1930s is in large part what led to the conflicts of the 1940s. And so we've had rising populism throughout the 2010s, sometimes between countries, but a lot of it is just inside of countries. And then as we've entered the 2020s, we entered the next shock, which was the pandemic, and then you lock down everything, and then you have such a highly leveraged system still that it can't lock down. So you have to just print a gazillion dollars is the problem. And you have wartime finance. It looks like a war, at least it wasn't a war yet, but the financial situation looked like a war. And then you also run into a situation where due to that deleveraging, you didn't have a lot of commodity supply growth because you've had low commodity prices, low demand. And then the problem is you exhaust that, surplus. So, you've drawn down some of the reserves, your demand is upticking over time, mostly from emerging markets. And so as that kind of populist deleveraging situation run into crises and run into commodity shortages, that's where you get phase two. That's where you get the 1940s. That's where you get the wartime finance. So I've been making the comparison. The 2020s are like the 1940s in the sense that we've gotten past some of the private deleveraging, and now it's about the sovereign debt bubble. Now it's about all the debts already in the sovereign level, and they're running into high inflation, and they can't support super high interest rates, at least structurally for the long term. And so that's when you get an environment of things like financial repression, like what Japan's doing. That's when you get an environment of yields well below the inflation rate. That's when you get a period of rapid money supply growth from large monetized fiscal deficits. We saw that 2020 and 2021. We've obviously taken a pause here in 2022, but I think we'll see a resumption of that in the subsequent years. And we're kind of past this kind of like record period of tightening. So it's a sovereign bond bubble more than anything else. It's a sovereign bond bubble, and then by extension, it's a currency bubble. Currencies are the release valve in many cases for these highly indebted sovereign countries, especially ones that are short energy. There's a good chance you've seen the peak rate of change. So if you look at the United States, for example, we have trillion-dollar deficits as far as the eye can see. And that's just baked in the cake from demographics and entitlement structures, right? So you have the Fed try to tighten on one hand, but fiscal is still loose. At any point, they can pull another lever and do student loan forgiveness again. They can pass more bills like that, depending on how gridlocked they get. But even short of any of that, they have 5%, of GDP deficits, trillion-dollar deficits, and that's assuming that tax receipts don't fall off a cliff. If you have a recession, if you have a decline in asset prices due to so much tightening, you're likely to get a lagged response where tax income starts to stagnate. And then you actually get a wider deficit, not because you're spending more, but because just that gap between automatic spending and receipts is widening to some extent. You're getting less GDP growth. And so that's just more money still coming into the economy. And then a lot of that is inflation adjusting, right? So Social Security is inflation adjusting. Healthcare is dependent on healthcare inflation, right? Because they don't owe you a certain amount of dollars of healthcare, they owe you a certain amount of healthcare. And so I think that's the problem in developed markets around the world, which is there's not a clear way out of the trap that they're in. And so in a benign environment, I think it's like a slow grind where you just have kind of persistent inflation above yields. And so bondholders and cash holders are just getting devalued on a gradual grinding basis. And then you can punctuate that with more explosive events if you have like an acute energy crisis, if you have an acute war, and things like that. So people often say that demographics are disinflationary. As a population ages, that should be disinflationary. That's the argument, because older people consume less. And so when you look at Japan over the past couple decades, they've been disinflationary because it's a very aged society. There's not a lot of growth there. But the problem is, one, that happened during a period where you had China coming online. They could outsource, if they don't have enough young workers, they can buy stuff from China. They can buy stuff from Vietnam. They can buy stuff from, India, right? There's all these other demographics that they can draw from to support their aged society. They also did that in a period for the 2010s of commodity bear markets, right? So less inflationary pressures from that end. Now the problem is, what if everybody gets to that point, or what if the major powers all get to that point? What if China starts hitting peak demographics, which they arguably have, right? So you no longer have those rising young populations to support the older countries, and so you have a situation where, Europe, China kind of run into the situation that Japan did, and then there's no rising power big enough to offset that in the way that China offset Japan aging, for example. So the way I phrase it is that one country aging alone is kind of disinflationary, but all the major powers aging together is actually quite inflationary, arguably, because you have a labor shortage. It used to be, when Social Security was developed, there was dozens of workers for every one retiree, and now there's only a handful of workers for every retiree. That's basically stagflation in one of two ways. Either you have to increase taxes a lot and support that, which is slower growth, or rising taxes becomes untenable and cutting it becomes untenable, and you print the difference. And there's just not enough goods and services to go around, but there's still all these promises to those people.